Good Tuesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, please take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you are searching for investment advice, please reach out to a licensed professional. As always, this show is for informational purposes only concerning Market Chameleon's tools and products. With that, D, good morning.
Good morning, Will. How are you?
Good.
Let's get started. I'm going to share my screen here. And if you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you have a question, type it into that live chat on YouTube, and Will is keeping an eye on it. It'll let me know when questions come in and read it back to me. And to give you a couple minutes to put those questions in, we will start out taking a look at our pre-market report to see what type of insights we could get in the pre-market trading, and then we'll move on to our questions. Okay, so we're on the pre-market report, and up top, you'll notice this calendar view with summary statistics, what happened in a pre-market trading on those historical dates. And the idea here is to quickly eyeball and scan if anything unusual is happening on the most current date relative to the most recent history. We're going to review today's activity, which is October 1st over here. And here we see we have 574 stocks trading higher in the pre-market, 356 stocks trading lower. We have 358 million shares trading on up volume, 50 million on down volume, and we have $2.9 billion worth of stock trading higher, $1.4 billion worth of stock trading lower. So just from that perspective, looks like so far trading in a pre-market has a bullish bias or bullish lean. Let's continue, look at it from a couple more perspectives before we move on to our questions. I'm going to slide down here, and now we get this more granular view of what's going on in pre-market hours. We see stock symbols with price and price changes and volume. We also have our most active stocks, our biggest percentage gainers and biggest percentage decliners. We have 77 stocks that made it onto our biggest gainers list, 37 on our biggest decliners, and that also indicates a more bullish lean in the pre-market trading activity. So a couple things with this list, because stocks in a pre-market can trade with very low volume or very low liquidity, we do set certain trading thresholds for the stocks that have to meet those conditions before they can make it onto this list. Once they meet those thresholds, the stock can make it onto this list, and that will include stocks that are low cap stocks. It could include an ETF. It could be a leveraged ETF. It could be an inverse ETF or closed-end fund, and so forth. And to narrow down this group of stocks further, we could use the filters we have available to us up top. Here, I'm going to concentrate on, well, these two. Let's explain these two filters here. This one in my watch list, it allows you to save a unique group of stocks that you track. So you create a watch list with, let's say, 10, 20, 30 stocks that you want to track. You give it a name, it could be category or my favorites, whatever. Once you save that watch list, then you could use this filter to screen out this report using your unique watch list. So you save 30 stocks, and it'll filter and see if any of those 30 stocks meet the conditions required in this report. Similarly, we have this one in ETF, and I'm going to show an example of this filter. So when you click on it, you get these ETFs to select from, and these ETFs are broad-based uh, market index ETFs or sector ETFs. We're going to go ahead and select this SPY, for example. And what happens is when you select that ETF, the list below gets filtered by stocks that are holdings in that ETF. So the SPY ETF is the S&P 500 companies. That's what it's tracking, S&P 500. So you can see here it got filtered by stocks that are constituents in the S&P 500. And we see here 9 stocks made it onto our biggest percentage gainers list, 6 on our decliners. So a little bit more balanced, slightly leaning towards the bullish side from that perspective. So we gave it a couple minutes, reviewed this report. If you have questions, I'm going to move on to the questions.
No questions have come up yet, D, but Bob did mention some things about Boeing. It's down, I guess, in the early morning. They may have to issue 10 billion of new shares. So anyways, I don't know if anything interesting has happened in the options, but nothing has really popped up. Thanks for the comments, Bob. No questions, though, D.
Yeah, I mean, okay, no, I mean, I couldn't. Here's Bone. Yeah, so I wouldn't know, just looking at it, I don't know enough about it to talk about it, or if there's a specific question, I would talk about it. But since I don't have one, there's not much to review. But I could stay on Bone and maybe just look at other um, features
That'd be
that
great.
us.
Before you look at different features on Boeing, can I share my screen real quick?
Sure.
All right, you can take back it. Everyone look at the disclaimer one more time. Thanks, D.
Yep. So I'm going to share my screen here. And what we could do is let's go under the options chain. And what we'll do is maybe just review some of these available tabs above the options chain, such as like volume, open interest. So let's just take a look at the volume. And this is the volume in the options. And I don't remember if maybe we did recently review it, but let's just go over it unless we get a question pop up. And what this does is it allows you to quickly just visualize the option volume trades throughout the day using these bar charts, bar graphs. And in here, what it is for 5-minute trading intervals, it aggregates the option volume and then creates this bar that shows the magnitude of the volume. And then you see in the bar, it's color coded, it's stacked. Call options and put options, call options in yellow, put options in blue. So throughout the day, what this allows you to do is just kind of see if anything, maybe unusual happened, in a particular time of day by looking at a spike in volume, right? So maybe something around here, we see between 11:50 and 11:55, we see a little bit of a jump in the options volume that traded relative to, all the minutes surrounding it. We also had like a pickup here between 220, 225, 230, 230, 35, then dropped off. So this kind of lets us just visualize a timeline throughout the day. And if there's any particular moments, that looked unusual, and then we could go into time and sales, and take a look at it. Here's another one at 325, 330. And it just sticks out because you could see the ones that surround it, the volume bars that surround it, are much lower. So that kind of allows us to narrow down time frames if we wanted to look for maybe unusual option spikes in volume. This is a quick way to do it visually. Okay. Now, we could also look at the distribution of volume by the expirations. Now we see there are quite a bit of volume here, 127,000 contracts that traded in Boeing. But if we look at it, here's the options chain. Boeing has a lot of different expirations. You could, and this is right here ordered by the nearest term, October 4th, and then it shows you all the available expirations that have listed options. And you could see here, it goes down up to January 15th, 2027. So we do have the volumes here next to each expiration. So you can just, scan it with your eyes and see, like, October 4th sticks out, 38,000, October 18,000. But we could also just do it visually, a graph. So this way it's easier to just compare the volume by expiration relative to each other. So if we click on this by expiration, now we have a visual chart of the breakdown of option volume traded by expiration. And within that expiration, we also show the breakdown of the calls and the puts, right? So the yellow is the calls volume, the blue is the put volume, and here October 4th for sure is the largest traded volume in any expiration. But we could see that there's some significant volume still November 15th, mostly in the call options, October 18th. And, even something going all the way out to January 16th, 2026. So if anybody is interested in leap options or longer, dated, longer maturity options, there's some trading that happened even in January 16th, right? So let's say that was the expiration that we're interested in. Well, what happened all the way out there? What's going on? How's the distribution of volume January 16th? If we wanted to see it visually, right, just to see like visually what's January 16th, we could open this up and then find January 16th right here, 2026. So I could click on that. And now we get this breakdown of how the volume was distributed by strikes and even the time of day this traded. So here, one interesting is if we look at the time of day, well, we could see that it wasn't one trade. It looks like, that there are a couple times that something traded throughout the day in this leap, right? 10:30, 10:35, then it looks like 10:35, 10:40. Then we have a couple here, 225, 230, 1,000 contracts, 230, 235. So, so it traded a couple times throughout the day, this particular expiration. What about a concentration of volume based on a particular strike or option? So that's what this visual chart will show us. And here we could see these are the different strikes in this expiration. So you could see it goes from 80 to 390 that we see. But a couple strikes stick out, these three in particular, the 240 strike, 260, and 270. So we got 240, 2,000 contracts, 260, 1,600, 270, 1,600 could be a spread. We'll go look at that. But now we know that the bulk of the trading, right? The bulk of the option volume is between the 240 and 270 strikes, which is, way above the spot price, like out of the money. We're talking about, $100 out of the money. So now we got a sense of like, what happened in there in the leaps, and we could like go dig deeper in there. But at least now, we quickly were able to visualize, what's kind of where the concentration of volume, how it traded. And of course, we could just go down here. Here's the gens 16, 20, 26, 5,994 contracts. So if we click on it, we'll get an options chain. And this options chain, let me close this menu. Now this options chain has the calls on the left-hand side. So these are the call options, the puts on the right-hand side, and these are the strikes. So this is just a standard view of an options chain. And we have the volume for the calls here next to each option and the volume of the puts. So just if we wanted to see the most active calls and puts, so if I click on this most active, so you could see here 240, 2,000 contracts, 1,600, 1,600. We'll go click on that. This will give us more details. So now I have the time in sales, the actual time in sales of the trades that happen on this call. See, January 16, 240 call. And it looks like 5 trades. So there are the 5 trades total. Here are the big ones. At 2:27 and 10 p.m., 1,000 contracts traded at 565. And at 2:31:27, another 1,000 contracts traded at $5.85. This was the market at the time, $576. This one's $560,605. This is the volatility that the implied volatility that the options traded. This is where the stock price was at the time of the trade. And here is the condition that it was stock contingent. So both these trades were stock contingent. Okay. What does that mean? That when this traded, it involved another leg to that options trade. It wasn't just buy or sell the option. It was, buy and sell the option with a stock contingency. So you had to have both executed at the same time. All right. So that's what these two 1,000 lots are. So let's take a look if we could find those. All right. So let's go now and look at our multi-leg trade analyzer. So I'm going to go to the multi-leg trade analyzer. And the stock contingents will be in there because, it involved more than single leg trade. So let's see if we could find it in here. So here, January 16th. So here it is, 2:27. So there are 2 trades here. So you can see here, this is the last one I'm looking at in this row. So this is the interpretation of all these options trades. And what the multi-leg trade does is seeks out, analyzes the trade and says, okay, well, here's a trade that had another component to it, either another option, multi-leg, or stop. So the fifth one here, you can see 2,000 contracts in a total of 2 trades, right? That we know because we saw both of them 1,000, 1,000, and 2 of them traded between 227.10, 231.27, January 16th, 240 call, and there's 21,000 shares of stock that we detected on the exchange that was related, that we believe is related to this trade. And you can see days to expiration 473. So it's a leap. It's out there. It's going to take a while for this option. So let's open that up. I'm going to open this up to get more details. So this is where, just like a summary of where the option closed out, 596.30. It traded at $5.85. So we saw that already. Volume 2,000, did 2 trades. So if we, open this up, we're going to get more details. And here what we see is the following. That yesterday in the morning, the open interest was 2,856. This morning, the open interest was 4,648. So it increased by 1,792. So it looks like these positions were new positions opening up. Okay, so it added to the open interest. So so there's new open interest. Okay. And let's keep going down further. And here are the details of the 2 trades. So this we got from the time in sales. At 231.27, there was a trade, 1,000 contracts for 585. Right? This market was 566.05. The stock price was 151.49. It traded on the Philadelphia Stock Exchange. And the delta of that option trade, so based on the delta that we projected, with our assumptions, is 20,000 deltas. In other words, if you bought the call option, you're long 20,000 deltas. If you sold the option, you're short 20,000 deltas. Well, and keep in mind, deltas, it's based off the option pricing model. So the option pricing model has assumptions that you're putting in, like interest rates, stock reference, and all that. And we see that on the New York Stock Exchange, there was a contingent trade, 21,000 shares at a price of 152.20. So based on the proximity of these trades and that this is a contingent, we matched it up as this is the most likely other leg of the trade.
Hey,
right?
hey D.
Yeah.
Sante was asking, could that contingent be a hedging against the option? Is that what's going on?
Yeah, exactly. That's what you were looking at. Is it a hedge? So here it looks like a hedge because it's very close to the delta that we projected. So keep in mind, our delta projected may not be the same as somebody else's model. They're usually close, right? They'll be close, but there's going to be a little bit variation because it's what you plugged into the model. It's like, the model, you're required, well, what's the stock reference? So here you have 2 stock references. This one's 1.5. It actually traded 152.20. We're referencing 151.49 because that's where the stop was at the time of the trade. Interest rates, dividends, how you treat days to expiration. Like, do you take out the weekends? How do you compensate for holidays, half days? So when we calculate a delta, it's an estimate based on the inputs in your model. No matter what, everybody's going to need to put some kind of inputs and assumptions, right? We're not all going to have the same assumptions and inputs, but they should be kind of close. It wouldn't be like, if If one projects 30 delta and another 80, then something's wrong. But 30, 31, 32, 29, you're going to get it, you're getting it close. And that's because the option pricing model, it needs assumptions. So here it's very close. We're talking about, we projected that this trade had 20,000 delta. The stock was 21,000. So that looks like it was that looks like a hedge to the options trade. That would be pretty close to the hedge. Okay. Because option hedges and option pricing models and option hedges, and we're talking about approximations, not exacts, right? The option pricing models are not, these are models used for approximations where you're trying to get close to what you need to hedge. So given that, that does look like a hedge, right? That whatever this 585, and you could see here that the stock crossed at 152.20, which is also 70 cents higher than where we saw the stock at the time, that the options trade was reported on the tape. Okay. So that's one thing you're looking at is, okay, the stock was a little bit higher maybe when the trade occurred, or with whatever they negotiated, right? Because whatever the input was, it required certain net amount based on stock price and option price. So it's either somebody here bought the option and hedged it with stock delta neutral, or sold the option and hedged it with stock delta neutral, right? But both sides, there's both sides to that trade. But that's what it looks like happened here. And it looks like, both of them on the Philex, and they both traded at the same, right? Option price and stock price were the same in both instances. So it was done for, the net package was done for the same amount in both instances. So
Well, that was
that's
awesome, D. Super helpful. Everyone was thankful that you showed some of those tools. They haven't either seen them or they haven't seen them in a while. So thanks for that. It's cool looking at
awesome.
Boeing after the news too. Everyone have a great day. Safe trading day. Great job, D.
All right. Thanks everyone for joining. Stay safe out there.